Hello, I want to tell you about a time-tested plan that can bring growth, security, and privacy to your financial portfolio. Here at Republic Capital Group, our team has over 20 years' experience in stockbroking and financial advising. We have seen many people make great money when the markets were doing well and then take losses when the markets faltered. Over the last 5 years, most investors have been licking their wounds with their IRA or 401k accounts. If they were lucky, they've come out even since 2007. During that same time, using our strategies, many of our clients have seen healthy double-digit annual returns. That's right, while most people were taking hits in their portfolios during the 2008 recession, many of our clients were seeing large gains, and we can prove this with specific examples. It is possible to have a portfolio that can grow regardless of what is happening in the economy. I promise you, this strategy is very real, and we can put it to work for you. I want to take just a few minutes to give a brief overview of a strategy that can protect your family's long-term financial future. A few minutes is a small price to pay for a portfolio that is secure in any economic environment. The key to managing a successful portfolio is understanding risk. In a free market economy, the rate of return on an investment is related to its risk. A safe investment will yield a low rate of return, and a riskier investment will yield a higher rate of return to compensate the lender for the risks he or she is taking. However, our current economic marketplace is highly manipulated. Government regulations, subsidies, and artificially set interest rates all contribute to an environment where the rate of return you receive is often not related to the risks you are taking. Many times, investors are in a position where their investment carries a high risk but yields a low return. I am going to tell you about 3 types of risk, and I will also tell you how to protect your portfolio from these types of risk. You can't have growth and security in your portfolio without understanding these 3 risk types. The first type of risk is currency risk. If you're like most people, your investments are held in US dollars. Unfortunately, the US dollar is losing value. The US government spends $1.3 trillion more each year than it collects in taxes. The U.S. has been borrowing so much money that its credit rating has been downgraded by the S&P, and both Moody's and Fitch are calling the financial outlook for the U.S. negative. In April 2012, Egan-Jones downgraded its rating of the U.S. for the second time. In order to cover its debts, the U.S. has had to borrow money year after year. Lately, however, the U.S. has been unable to borrow enough money. PIMCO, formerly the largest domestic purchaser of U.S. bonds, has stopped buying. And then there is China. At this point, China is only purchasing short-term U.S. bonds, and it is openly selling its long-term U.S. bonds. People have been asking for a while, what will happen if China stops buying our debt? Well, that time is beginning to arrive. In 2011, 61% of U.S. debt went unsold. The U.S. was unable to borrow 2/3 of the money it needed to borrow. The Federal Reserve had to cover this debt by creating money out of thin air. This is called monetizing the debt. As more money goes into circulation, the money in existence becomes less valuable, causing inflation. Through history, whenever a country has monetized its debt, it has ruined that country's currency. This has happened so many times that it would be crazy to think it won't happen this time. We are already seeing this inflation happen. Based on the official government CPI, inflation was over 3% in 2011. 3% compounded can quickly devalue a portfolio. Also, the government numbers may not tell the whole story. The government changed the way it figured inflation in the 80s and then changed it again in the 90s. The government stated that the reason it changed the way it figured inflation was to come up with a lower number. If we figure inflation the same way it was figured in the 80s, inflation now is currently over 10%. Any American that has had to pay for food, energy, education, or healthcare recently would probably agree that 10% feels like a more accurate number. If all of this talk about the dollar is depressing, don't worry. We have a time-tested method to protect your portfolio from currency risk. But before we get to that, let's talk about the other 2 types of risk. The second type of risk is interest rate risk. This type of risk is closely related to currency risk. What is the real return you are getting on your investments? When looking at your portfolio statement, the number of dollars it shows may be increasing. However, as the dollar falls, the purchasing power of your portfolio may be shrinking, with energy, food, and healthcare costs rising 8 to 10% a year, has your portfolio been keeping up with the real cost of living? When interest rates are set by the market, they accurately reflect the level of risk involved. However, most interest rates, such as interest rates for savings accounts, CDs, and Treasury bonds, are based on arbitrary interest rates set by the Federal Reserve. Once you take risk factors into account, most investments yield a negative return. On this chart, the blue line shows the return in dollars of a 20-year Treasury bond. The red line shows the real return, if you assume an inflation rate consistent with official CPI inflation. After 20 years, the original $1,000 has shrunk to $928 in purchasing power. Here is another example. The blue line shows a stock portfolio with a return of 4%, which is almost twice the average S&P rate. After 20 years, this portfolio seems to have doubled in value. However, if you account for SGS inflation, which is inflation figured the way inflation was figured in the 1980s, then after 20 years, the original $1,000 has shrunk to $266 in purchasing power. Getting an interest rate that properly accounts for currency risk is vital to having security and growth in your portfolio. We will show you how this is done in just a minute, but first, let's talk about the last type of risk. The third type of risk is what we call principal risk. Many investments have inherent risks of their own, above and beyond currency risk and interest rate risk. One thing to consider is how much control you have over your money. If you are investing your money directly into a CD or annuity or bond, you are once removed from your money. If you have a broker that invests your money for you, you are twice removed from your money. The farther you are from your money, the less control you have over risks that may be hurting your portfolio, such as fraud or mismanagement. It is also more difficult to get at your money when you need it. Also, CDs, annuities, and bonds lock your money away for a set period of time and don't allow you to get at that money when you need it without a penalty. So are you ready to hear the solution to these types of risks? Are you ready to hear how a portfolio can grow 10, 20, even 30% a year under any economic conditions? The answer is diversification. But in order for this to work, it has to be a very special type of diversification. You have to diversify among different asset types so that when one type of asset goes down, the other is going up. Stocks, bonds, annuities, and CDs are all in the same category of assets. We call these assets correlated because they are all affected by the market in a similar way. These assets are all affected by the interest rates set by the Federal Reserve and by the health of the economy overall. IRAs are also correlated when they are invested in these types of assets. Even real estate and peer-to-peer lending are correlated to the health of the overall economy. The secret to achieving secure, long-term growth in your portfolio is investing a large portion of your portfolio into asset classes that are not correlated to the rest of your portfolio. This is a strategy that has worked for thousands of people, and we can put it to work for you. Here is an example of 3 portfolios. In this example, each person invests $50,000, but each person gets very different results. Kevin invests his money equally into 5 of the top stocks in the market: GE, Johnson & Johnson, Merck, Citigroup, and AT&T. After 3.5 years, Kevin's portfolio has lost value. Steve also invests into the same 5 stocks as Kevin, except he puts 30% of his portfolio into a non-correlated asset. Steve's portfolio does much better than Kevin's and sees a 20% gain over 3.5 years. Our third investor, Kate, also invests in the same 5 stocks Steve and Kevin did, except she puts 30% into 2 different non-correlated assets. Kate does the best by far, and her portfolio nearly doubles over 3.5 years. So what specifically are these non-correlated assets? In order to find out that secret, you'll need to become one of our exclusive Republic Capital Group members. But believe me, this example is based on real data from actual market transactions, and you can see all the details once you become a member. Let's look at a longer-term example. This example takes place over 17 years and spans the 2008 recession. Once again, each person invests $50,000. Just like before, Kevin invests his money equally into the same 5 top-tier stocks. Kevin sees good gains during the boom years of the late 90s, but loses much of his profits during the 2008 recession. Once again, Steve puts 30% into a non-correlated asset. Steve's portfolio doesn't do quite as well as Kevin's during the boom years, but once boom and bust years are averaged out, he comes out ahead of Kevin. In our third example, Kate once again puts 30% into two different non-correlated assets. Kate's portfolio does the best during both boom and bust years, and after 17 years, her portfolio is worth more than Steve's and Kevin's put together. Just like last time, this example is based on real data from actual market transactions. As a Republic Capital Group member, we will be happy to share the specific details with you. Becoming a member is easy. All it takes is for you to fill out our membership form, giving us some details about your current portfolio. We use this information to help create a portfolio recommendation for you. One of our account specialists will call you to give you the details of our recommendation. We do all the work, but the decision is always up to you. Take advantage of our decades of experience. Our current economy can be a scary place to invest when you're investing only in the same correlated assets. You never know when the next turn in the market can take a hit on your portfolio. Don't let this opportunity pass you by, or you may get lost again in the world of traditional investment thinking. A portfolio with security, growth, and privacy is only minutes away. Apply now to become a Republic Capital Group member and find that peace of mind shared by a special few.